MAGY is the Roundhill Magnificent 7 Covered Call ETF. It is designed to give investors weekly income from the most powerful stocks in the stock market: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. These 7 stocks have been responsible for more than 50% of the total return in the S&P 500 over the past few years. MAGY takes those 7 stocks, combines them into one ETF, and then adds a covered call strategy on top to generate weekly option income. This structure allows you to earn consistent income while still participating in some of the upside of these tech giants. But there is a trade-off. You give up some of the explosive gains during big rallies because of the call options being sold. Let us break it all down. First, MAGY holds equal-weighted positions in the 7 mega-cap tech leaders. Each stock starts out with roughly 14.3% of the portfolio. This is different from most ETFs that are market cap weighted. That means Tesla gets the same weight as Apple, even though Apple is a much larger company. The goal is to give each of the Magnificent 7 an equal chance to contribute to returns. Second, the fund sells weekly at-the-money call options on 100% of the notional value of the portfolio. These options are written on a laddered schedule, meaning the expirations are staggered throughout the week to smooth out the income and reduce timing risk. This strategy generates option premium every single week, which is collected and distributed as a monthly dividend. So while the income is earned weekly, it is paid out monthly. This approach is known as synthetic income. You are not receiving dividends from the stocks directly. Instead, you are earning income from selling options on those stocks. As of 2025, the average monthly payout for MAGY has been around 40 to 50 cents per share. That means if you own 100 shares, you are earning roughly $40 to $50 per month. That works out to an annual yield between 10% and 12% depending on share price. That is extremely high for a portfolio of the world's top tech stocks. But keep in mind that the call options limit how much price upside you capture. If Nvidia rallies 10% in 1 week, MAGY might only capture a portion of that move because the upside is capped by the option contract. That is the trade-off. You get consistent income but lose some growth. Now let us talk about risk. MAGY is concentrated in just 7 companies, all of which are in the tech sector. That makes it more volatile than a broad market ETF. If tech stocks crash, this fund will take a big hit. However, the call option income can help cushion the downside slightly by generating cash during market corrections. But make no mistake, this is a high-risk, high-reward fund. It is not designed for safety. It is designed for aggressive income investors who are comfortable with volatility. Now, what about the sustainability of the dividend? Covered call income is generally reliable as long as there is volatility in the market. As long as the Magnificent 7 continue to move, even if it is sideways, the fund can collect premiums and pay dividends. But if the market goes totally flat and volatility drops, the amount of income generated could decline. Additionally, in major bull markets, the fund will underperform because it gives up upside in exchange for income. The fund is best suited for sideways or choppy markets where price movement is happening but not exploding higher. Now let us talk about fees. The expense ratio for MAGY is 0.75%. That means for every $10,000 invested, you are paying $75 per year in management fees. That is higher than a passive index fund, but reasonable for an actively managed covered call strategy with weekly execution. You are paying for the automation and the income strategy. Assets under management are still growing, with more investors turning to covered call strategies as an alternative to bonds or dividend stocks. Now let us go over the income examples. 100 shares of MAGY earns about $45 per month, or $540 per year. 500 shares earns around $225 per month, or over $2,600 per year. 1,000 shares can generate more than $450 monthly, or over $5,000 annually. That is a powerful stream of income from just 7 companies. Now, how does MAGY compare to other income ETFs? Compared to JEPI and JPQ, MAGY has a narrower focus and higher volatility. JEPI holds 200 stocks, MAGY holds just 7. But the yield from MAGY can be higher in volatile tech markets. Compared to TSLY, NVDY, or MSTY, MAGY is more diversified because it spreads the risk across 7 names instead of 1. That makes it slightly more stable. Compared to YMAX or XDTE, MAGY is a pure tech play without as much synthetic exposure or swap usage. It is a clean, straightforward, fully covered call fund focused on the strongest growth companies. Let us score MAGY on my meter rating. Income gets a 9 out of 10. Monthly payouts are strong and consistent. Risk gets a 6 out of 10 due to the tech concentration. Sustainability scores a 7 out of 10. It works as long as tech remains volatile. Growth potential gets a 5 out of 10. You give up upside in exchange for income. Simplicity scores an 8 out of 10. It is easy to understand and execute. My total score is 7 out of 10. MAGY is a high-income play built on the backs of the most powerful tech stocks in the market. It is not a set-it-and-forget-it ETF. But for aggressive income investors who want a piece of the magnificent 7 plus regular cash flow, MAGI delivers a strong balance of exposure and yield. If you have any videos you would like me to cover, say it in the comments below and I will break it down in plain English.